World shares climbed to near a 3-week high and safe haven German bonds fell on Tuesday, after global lenders agreed a new deal to reduce Greek debt and release loans needed to keep the country afloat. After 12 hours of talks, they decided on steps to cut Greek debt to 124% of gross domestic product by 2020, and promised further measures to lower it below 110% in 2022. Following the months of jockeying, the deal was broadly expected by markets and clears the way for Greece's Eurozone neighbors and the International Monetary Fund to disburse almost €35 billion of aid next month. European shares on the EFTS Europeers 300 index. FTEU3 were up 0.4% by 0.905 EDT following the deal, with London's FTSE 100. FTSE, Paris's CAC 40. FCHI and Frankfurt's DAX. GDAXI between 0.3 and 0.5% higher. LEU.N. The MSCI index of global stocks. MIWB 00000 plus was up 0.2% and U.S. futures prices pointed to a steady open on Wall Street when trading resumes. After 3 meetings this month and a total of more than 24 hours of discussing and negotiating, the Eurozone countries have put their money where their mouth is, said economist Karsten Piarczewski. The political will to reward the Greek austerity and reform measures has already been there for a while. Now, this political will has finally been supplemented by financial support. With doubts about Greece's ability to hit its growth and debt-cutting targets, few analysts expect the latest agreement to be the final chapter in the Eurozone's 3-year crisis. The worries tempered the optimism of investors. The euro hit $1.3010 in Asian trading, its highest level since October 31, but lost momentum as caution set back in and was down 0.35 at 1.2940 by mid-afternoon in Europe. Also underscoring the concerns, the OECD slashed its global growth forecasts on Tuesday, saying the Eurozone's troubles were the greatest threat to the world economy. While the EU/IMF agreement on Greece is supportive, it was widely expected and hence the market reaction is likely to remain muted. We maintain our buy on the IB's strategy, Morgan Stanley's FX strategy team wrote in a note to clients. Michael Hintze, founder and CEO of hedge fund CQs, told the Reuters Summit he expected the Eurozone to continue muddling through its troubles, but added that the chances of misstepping on the way through are pretty high. Safe haven SAC. Elsewhere on the currency markets, the dollar was broadly flat against a basket of key currencies. DXY, while the yen slipped after Japan's opposition leader and likely next prime minister reiterated calls for bolder monetary and fiscal stimulus. Safe haven German government bonds fell following the Greek deal, with benchmark bonds down 35 ticks at 142.09 as 10-year Greek yields steadied near lows last seen when the country's debt was restructured in March. Too much of the deal has been anticipated. It's not a real game changer. We expect some upside pressure on bond yields but not a sustained sell-off, said Michael Leister, the senior rate strategist at Commerzbank. The Greek deal is not the green light for a sustained rally for risk assets across the board. As we've seen before, once the market starts scrutinizing some of the details, some doubts may well arise, he added. The Greek agreement helped copper to a 3-week high of $7,791.50 a ton, while oil gave up early gains to stand just under $111 a barrel as optimism was countered by worries over looming tough U.S. fiscal decisions. After an initial post-Greek deal jump, gold steadied before being pushed lower to $1,746.39 an ounce by comments from Federal Reserve hawk Richard Fisher, who voiced caution about U.S. monetary stimulus. U.S. focus. In Asian trading, MSCI's broadest index of Asia-Pacific shares outside Japan. By ATJ0000 plus gained 0.6% to a near 3-week high, led by a 1% advance in Korean shares. KS11 and a 0.7% rise in Australian shares. AXJO. Indian shares. BSESN jumped 1.2%. Shanghai shares. SSCC bucked the trend to fall 1% to their lowest since 2009, dragged by weakness in growth-sensitive companies. U.S. stock index futures pointed to a steady open on Wall Street, with investors fixed largely on talks between the Obama administration and Congress to avert a series of spending cuts and tax increases scheduled to begin next year. which threatened to drag the economy into recession. The gauge of planned U.S. business spending increased by the most in 5 months in October, data ahead of the open showed, but a fourth straight month of declines in shipments underscored the damage that fears of tighter fiscal policy next year are inflicting on the economy. Advancing volume trends have failed to surge during the S&P 500's 4% bounce from its November 16 low, suggesting recent strength can be attributed to a lack of selling pressure rather than fresh buying demand, said Ari Wald, analyst at the Princeridge Group in New York. We would like to see this spread turn positive to confirm an upward S&P 500 reversal,